The promise of AI price discrimination is simple. Charge closer to what each customer is willing to pay. The margin problem begins when every extra distinction becomes something the business must maintain, defend, and explain. In US enterprise settings, finance teams reviewing these systems often see early lifts in average revenue per account from models that adjust offers according to behavioral signals. The question that follows is whether those lifts survive once the organization must sustain the distinctions against leakage, competitive response, and shifts in customer behavior. The common assumption holds that more granular price discrimination simply reduces the uncaptured surplus between cost and individual reservation values, thereby lifting gross margins with limited side effects. In practice, the mechanism meets surface economics, but carries structural fragility once the full cost of sustaining the distinctions is recognized. What appears as an incremental pricing capability quickly becomes an ongoing operational process whose economics depend on conditions that quarterly reporting cycles and legacy system constraints rarely hold steady. If the relationship is sketched as layers, uniform pricing leaves a broad band of uncaptured value above direct cost. Basic segmentation narrows that band modestly through observable cohorts. Advanced discrimination multiplies the thin slices captured above cost, yet beside each new slice runs a parallel requirement for continuous data pipelines, model maintenance, and controls that prevent leakage across segments. The sustainable position on the sketch appears only where the added capture exceeds the added overhead across the distinctions that remain active. That framing already narrows the initial view. The revenue lift from finer alignment to willingness to pay is real within the observable data window, yet it is not free of the infrastructure and enforcement burden required to keep segments from collapsing into one another. The margin expansion therefore holds only while data quality remains high enough to support the distinctions and while billing latency and override controls do not add material operating drag. Under US enterprise conditions, the pressure to demonstrate contribution margin improvement within a fiscal quarter often accelerates deployment before those sustaining costs become visible in full. Legacy billing platforms and CRM environments, built around uniform or simple tiered structures, require adaptation layers that add both direct expense and latency to offer changes. Pilots on limited cohorts can show revenue per transaction gains, yet scaling frequently surfaces data, inconsistencies, and increased support burden that offset part of the initial appearance. The pattern reflects mismatch between the speed of pilot results and the slower recognition of operating drag once the system interacts with existing workflows. The models can isolate distinctions in willingness to pay that legacy, rule-based approaches could not resolve at comparable cost. At the same time, protecting those distinctions against customer arbitrage, internal overrides, or rapid competitive matching requires dedicated monitoring and response capacity whose costs do not decline with volume in the same proportion as inference sometimes does. The operating leverage benefit therefore materializes only when the incremental revenue persists long enough to amortize the supporting systems and when the organization maintains discipline over how many distinctions remain active before complexity costs accelerate. The models surface additional margin in the pricing layer by isolating finer differences in willingness to pay. Yet each distinction adds cost in the enforcement layer through monitoring, override controls, and rapid response to competitive matching. The advantage is real only if the second layer grows slower than the first once the system operates at scale. Competitive dynamics in US markets further constrain the window. Once multiple platforms gain access to comparable data sources or third-party signals, the period during which one firm's segmentation remains distinctive tends to shorten. Rivals can observe offer patterns or replicate core approaches through similar tooling, which compresses effective pricing power back toward prevailing industry levels. The margin contribution then depends less on the technical ability to discriminate than on the relative cost and speed of sustaining the system against imitation. Customer response introduces an additional boundary condition. When distinctions become too fine or feel inconsistent across touchpoints, acceptance rates can decline and downstream churn can rise, reducing lifetime value through cohort-level LTV decay and therefore the long-term margin contribution of the affected groups. What registers as a pricing gain in one period can reappear as higher acquisition or retention cost in later periods. The net effect on gross margin and operating leverage must be observed through segment-level contribution trends rather than headline revenue per transaction alone. The capability therefore functions as a conditional lever rather than an unconditional margin expander. It improves captured value most reliably where data advantages prove durable, where switching costs limit immediate customer reaction, and where internal controls keep the number of active segments from outrunning the organization's ability to manage them cleanly. It narrows where any of those conditions weaken or where the cost of enforcement scales faster than the incremental capture. Under quarterly budget discipline, the temptation to expand segmentation scope before those trade-offs are measured remains a recurring source of margin fragility. Returning to the layered sketch, the additional slices of captured margin do not stand alone. Each carries its own sustaining cost band that must be weighed against actual utilization rates, competitive response times, and observed changes in cohort retention. The economic advantage holds where the net layer remains positive after those costs are recognized. It narrows wherever the overhead of maintaining distinctions grows faster than the revenue they isolate, or wherever competitive imitation shortens the period over which any single distinction delivers incremental value. This is where advanced price discrimination creates margin, and where the economics begin to take it back. Sustainable pricing power therefore depends as much on the economics of maintaining differentiation as on the economics of creating it in the first place.